Hey everybody, welcome to Mortgage Today for Tuesday, April 2nd, 2024, and oh, what a day it was. Oh, man. The UMBS were down another 15 basis points on the open. Stock futures were down 41.5 points. April is not shaping up to be a great month for bonds if the first 2 days are any indication. Treasuries did a good job of ignoring the initial spike in European bond yields. That was the right move considering Europe was closed yesterday, and it was a foregone conclusion that yields would need to rise to catch up to the U.S. bond market. But Europe sold off again later in the session following a series of stronger PMI reports. Japan's warning of intervention on yen weakness set an unsupportive tone in the background as well. Then we got the JOLTS report. So job openings came in at 8.756 million on 8.75 million forecast, pretty dead on. It was 8.748 million previously, so staying pretty steady, which kind of need more job openings. Then the quits rate came in at 3.848 million versus a 3.385 million previous. If either of these two numbers above had been much higher than expected, it would have been bad news for rates, with the results being as close to as expected as it gets. It's not surprising to see any absence of a major reaction. We also got construction spending. Construction spending fell 0.3% month over month in February. Construction spending fell 0.3% month over month in February, according to census. This was up 10.7% compared to a year ago. Residential construction rose 0.7% month over month and 6.5% year over year. We continue to see a big bifurcation of single-family versus multifamily. Single-family private construction rose 1.4% month over month and 17.2% year over year, while multifamily construction fell 0.2% month over month and rose only 6.1% year over year. I'm surprised it's rising at all year over year with all the catastrophes going on over there. Bonds began the day in much weaker territory as treasuries followed European yields after a series of stronger PMIs overnight. Domestic traders added to the weakness early, with 10-year yields hitting their highest level since November. Bonds found their footing after an as-expected JOLTS report, and UMBS even made it all the way back to unchanged just before 3 p.m. Nevertheless, 10-year yields had broken their recent 4.32 ceiling. As always, technical levels don't predict the future, though. The breakout reinforces the headwinds of the past 2 weeks. The breakout reinforces the headwinds of the past few weeks and acknowledges the risks associated with the incoming data. If that data is friendly, this will not look like an important technical breakout in hindsight, but the opposite is also true. Stronger data will make this breakout look like ominous foreshadowing. UMBS ended the day up 7 basis points at 100.67. That 10-year closed at 4.357. So at 100.67, that puts us right in this wide technical range. So we have a ceiling at 100.392. We have a floor at the 50-day moving average at 100.76. UMBS closed the day up 7 basis points at 100.67, which is a pretty good turnaround. So that's like a 20 basis point swing right there on the day, which is pretty awesome. The 10-year yield ended at 4.357, which is breaking through that technical indicator, that 4.32, and at 100.67, that puts us in a weird range right here. Very, very tight range. We have a ceiling at the 50-day moving average, which if we can break through, there's a lot of room to the upside. But we have a convergence of several technical indicators. It looks like that is the 25 and the 100-day moving average moving into each other right at today's close. So we don't want to break to the lower on that, that's for sure. But in terms of things you can control, is check out a post from our sponsor here at wellthatmakesense.com. This is our final video series from the Fifth Agreement, which is probably the best book per word for self-improvement you'll ever read. Very short, very dense, very awesome. So if you don't like to read, check it out on our sponsor at wellthatmakesense.com and watch the video.